If you're watching this video, you aren't just looking for a ticker symbol, you're looking for a work-optional life. You're looking for a way to replace a 2,000 yuan a month paycheck, the kind of steady, reliable cash flow that covers the mortgage, the groceries, or the health insurance premiums without having to clock in at Joe AM for decades. The experts told us the way to do this was simple. Follow the Baffinger rule. They said if you saved up a big enough nest egg and withdrew Baffinger every year, you'd be set for life. But let's do the math on that. For 2,000 monthly goal, to get 2,400 yuan a year using the Baffinger rule, you would need a staggering 600 yuan, saved up. And here is the kicker. In today's world of high inflation and volatile markets, many retirees are finding that Baffinger just doesn't cut it anymore. Bonds are paying less than they used to, and the 6 to fading portfolio is looking more like a 6 to fading 小时一dig. But what if there was a more efficient way? A way to generate that same 2,000 yuan a month with significantly less capital. Enter the JP Morgan Equity Premium Income ETF, better known by its ticker JEPI. It is currently the king of what we call derivative income. Instead of just waiting for a stock price to go up, JEPI creates its own synthetic paycheck. Today, we are going to break down the exact math. I'm going to show you why the minimum amount of money you need might surprise you, but also why the safe amount is higher than most YouTubers are telling you. If you are Sishawu or older and you're tired of the buy and hope strategy, pay close attention. This is the blueprint for replacing your labor with capital. The engine under the hood. How JEPI actually works. Before we get to the dollar amounts, we have to understand where this money is actually coming from. JEPI isn't magic and it isn't a scam. It is a hybrid vehicle managed by one of the largest banks in the world, JP Morgan Chase. Think of JEPI like a two-part engine. Part 1 is the defensive core. JEPI puts about Baffinger of its money into a basket of stocks that are intentionally boring. We're talking about low volatility companies. The kind that don't drop as hard as the rest of the market when things get ugly. They use what is called a low beta strategy. In plain English, that means when the SVP Wudining drops by Baffinger, JET's goal is to only drop by, say, Baffinger Liu or Baffinger T. It is built to be a shield, but boring stocks don't pay a Baffinger T or Baffinger dividend. So, where does the rest of the cash come from? That is part 2, the secret sauce. JEPI uses something called equity-linked notes, or ELNs. Now, don't let the Wall Street jargon scare you. Think of an ELN as a way for JEPI to sell insurance to other investors. When the market gets nervous and people are scared that stock prices will fall, they are willing to pay a premium to protect themselves. JEPI basically says, we'll take that risk for you, but you have to pay us a fee up front. JEPI collects those fees, those premiums, and passes them directly to you as a monthly dividend. They're essentially harvesting market fear and turning it into your salary. The volatility trap, why your salary isn't fixed. Here's the first reality check you need to hear. If you decide to replace your 2,000 salary with JEPI, you need to understand that you no longer have a fixed salary. You have a variable one. JEPI's income is structurally linked to something called the VIX, the market's fear gauge. In 2,000 RR, the world was a mess. Inflation was spiking, interest rates were climbing, and investors were terrified. Because fear was high, JEPI was able to charge very high fees for its insurance. Some months, shareholders were seeing payouts as high as 50 cents per share. But look at 2,000 RC. The market has been calm. People aren't as scared. When there is no fear, JEPI can't charge as much for its insurance. Recently, we've seen those payouts drop down to around CNY or CNY per share. That is a Baffinger CNY drop in pay. If your boss told you that you were getting a Baffinger CNY Pasaka Y cut because people are too happy at work, you'd be furious. But with JEPI, that is part of the contract. You get a raise when the world is ending and a pay cut when everything is going great. This is why you can't just look at the average yield on a website and call it a day. You have to plan for the floor, not the ceiling. The Math of Freedom scenario, a tax-optimized model. Now, let's get into the hard numbers. We'll start with the best-case scenario. This is what I call the tax-optimized model. This assumes you are holding JEPI inside a Roth IRA or a traditional IRA, where you aren't losing a chunk of every check to the IRS immediately. To get 2,000 yuan a month, you need 2,600 yuan a year. If we look at the historical data, the average monthly payout is roughly 12 to 13 cents per share. If we use that average, the math tells us you would need about 10 Wubai mouse hairs at a stock price of around 60 yuan. That is a total investment of 10. But wait, remember what we just talked about. The volatility trap. If you only buy 10 Wubai mouse hairs, there will be months where JEPI only pays out censure or censure R. In those months, your 210 salary suddenly becomes 10,650 yuan. If your mortgage is 10,800 yuan, you're in trouble. To truly replace a 210 salary so that you never fall below that number, even in calm markets, you need to calculate based on the floor. If we assume a low Jan-N payout of 20 cents per share, which is a conservative safety net, the math changes. To guarantee 210 yuan every single month, you actually need 10 Wubai mouse hairs at 60 yuan a share. That brings your safe lien requirement to 61 yuan. Is it more than the 10 yuan average? Yes. But this is your life we're talking about. You don't want to be average when the bills come due. You want to be certain the reality check scenario B, the taxable account. Now, let's talk about the situation most people find themselves in. The taxable brokerage account. This is where things get a bit sticky. Here is a technical fact you must understand. The income JEPI generates from those ELMs, those insurance fees, is not taxed like a regular dividend. It is taxed as ordinary income. If you're a Wushu-Wu-Year-Dan-Old American in the Baffinger RSHR tax bracket, the IRS is going to take RSHR cents out of every dollar JEPI sends you. If JEPI sends you 210 yuan, you only get to keep 10 Wubai 60 yuan. To actually put 210 yuan of spendable cash in your pocket after federal taxes, you need a gross income of about 210 Wubai 60 yuan per month. Let's do that math again. To get 210 Wubai 60 yuan a month at that safe payout of 20 cents per share, you now need 8,850 mouse hairs. Total cost Wubai 10 yuan, 000. And that is just federal tax. If you live in a high Jan-TE state like California or New York, you might need even more. You could be looking at a capital requirement of nearly Wubai 60 yuan, just to have the same lifestyle as the person with 61 yuan in a Roth IRA. This is what we call tax drag. It is the silent killer of retirement dreams. If you can always try to put your income generators like JEPI in your tax-advantaged accounts first, protecting the principal inflation and the capped upside, there is one more hurdle we have to clear. Let's say you hit your goal. You have your $500,000 in JEPI and the 210 yuan checks are rolling in. You're done, right? Not quite. We have to talk about your future self. The 210 yuan you need today to buy groceries and gas will not be enough in sheer years. Because of inflation, that 210 yuan GHT only have the buying power of 10 Wubai yuan by the time you're 60 Wu. With a traditional company like Coca-Cola or Home Depot, they usually raise their dividends every year to help you keep up with inflation. But JEPI doesn't do that. JEPI's payout is based on market volatility, not corporate growth. Furthermore, JEPI has what we call capped upside, because they are selling those insurance policies, the ELMs. They are essentially trading away the chance for huge gains. If the SVP Wudinin rockets up Baffinger censure in a year, JEPI might only go up Baffinger Shi or Baffinger Shir. You are sacrificing the home runs to get the steady singles. The solution: use a dynamic surplus strategy. At this share count, your 210 monthly floor is already secured. Growth happens automatically whenever the market gets volatile. When the payout hits Senshu Wu, you generate a Simeyuan Shidou Mouse surplus that you reinvest immediately. In peak months of Wuxi, that surplus jumps to over 10 Sibai yuan. This is true capital efficiency. You don't need a massive upfront buffer because you are harvesting the high-pay months to compound your shares and outpace inflation. The competitive landscape. Is JEPI the best tool? Before you go out and move your entire life savings into JEPI, let's see how it stacks up against the competition. First, there is JEPI-Q. This is JEPI's aggressive brother, while JEPI follows the SVP Wudinin. JPEC follows the Nasdaq Yaldini. Think tech stocks like Nvidia, Apple, and Microsoft. JEPI-Q usually pays a higher yield because tech stocks are more volatile, but it is a bumpier ride. If you're under Wushu Wu and can handle some swings, JPEG might help you reach your down 10 yuan goal with less capital, maybe only 10 yuan. Lean in. But the risk of a price drop is much higher. Then there is the gold standard of dividend growth, SHD. SHD doesn't use fancy derivatives or ELMs. It just owns solid companies that pay dividends. The yield is much lower, usually around 5%. To get down 10 yuan a month from SHD, you'd need nearly 7 yuan, lean. So why would anyone pick? Because dividend grows at about 5% a year, and music, the stock price tends to grow much faster than JEPI. The smart move. Many sophisticated investors aged 45 to 65 don't pick just one. They use JEPI as a bridge. They use it to get the high income they need now while keeping a portion in SHD to provide the growth they will need later. The execution blueprint. So, what is the final verdict? How do you actually pull this off? Replacing a Liang salary with JEPI is one of the most capital-efficient strategies available to the modern investor. It allows you to generate a private pension with about 5% less money than traditional methods. But as we've seen, the mathematical minimum is rarely the reality. Here is the 3-step execution blueprint. Step 1. Use the bucket system. Never rely on JEPI alone. Keep 6 months of your salary. Yuan down 10 yuan in a high-yield savings account. Withdraw from the bucket only for major unexpected expenses like car repairs. When JEPI has a high-pay month, put the extra into the bucket to refill it back to the yuan down 10 yuan limit. This ensures your safety net is reserved strictly for real emergencies. Step 2. Location matters. Prioritize holding JEPI in an IRA to avoid the 5% tax drag if you must use a taxable account, except that you will need roughly 120 yuan, lean M, or in capital to reach the same lifestyle. Step 3. Know your number. The lean goal 33.10 yuan risky, variable income. The safe goal 41.5 yuan covers the low months. The fortress goal 530 yuan, lean covers taxes, inflation, and growth. Remember, don't obsess over the daily price of the stock. Your job isn't to be a day trader. Your job is to be a share collector. Every share you add is another few cents of labor you've successfully offloaded to the market. JEPI is a powerful tool, but like any tool, it works best when you know exactly how to handle it. Start building your share count today, and that down 10 yuan a month freedom might be closer than you think. If you found this breakdown helpful, make sure to check out my other videos on dividend strategies. Until next time, keep building your nest egg.